I am very upset to answer this question because in December of 2018, we locked in for 5 years at 428. And today it would be so much lower. We just hit it at the wrong time. In the December, there was a rise in the bond market and the Bank of Canada increased the rate. And now they said, oops, we may have raised it too much. So I'm quite upset to answer the question. But I do think we could see, not a lot further drop in the 5 and 10 year money, maybe 5 to 15 bips, which is good, but not necessarily material. That said, it's not the interest rate that could affect the liquidity and valuation of real estate in Vancouver. It's the loan to value ratio. What we're finding is that people are willing to lend relatively cheap money, but not giving great leverage. And that then requires more equity. So I think if you get the combination of low interest rates and great leverage, then you're going to see prices go up. However, if the mortgages are going to be 50 to 60% and there's a great deal of equity that's required, it's less likely that you're going to see a big bump in the capital value of the real estate. All this being said, it's a wonderful environment in terms of the debt side of things. Okay? In fact, what's happening is some traditional equity players in real estate are now saying, I don't want to live with the yields, I would rather give debt, okay? And fill that space between 50% and 75% at much higher rates than 4%.
Our belief is really through the spike in interest rates that we saw late last year, that cap rates really remain stable. The spread between bond rates and cap rates widened out and has subsequently narrowed, and bottom line is cap rates have actually been quite stable through that period, despite the volatility on the interest rate side. The interesting thing about the Vancouver market with respect to cap rates is the cap rate as a metric is very challenging in the valuation of real estate in this market, because there are virtually no stabilized assets in the market at this point. Almost all assets that we're looking at from an acquisition perspective are rented considerably below market in the industrial, residential, rental, and office asset classes. So when you look at a cap rate, you're almost looking at cap rates in the future, 3, 4, or 5 years out, where you can actually get your rental rates marked to market in the assets. Retail is probably an exception to that, where rents have not moved remarkably, and really I think the stabilized, quote-unquote stabilized asset in the retail sphere still exists, but in the other spheres we're really looking at almost more of a time value issue, and we're really looking to the future and what's going to happen in the future in terms of persistence of current market rental rates and growth rates out 3, 4, 5 years. So it becomes a real underwriting challenge when we look at acquisitions in this market.
So interest rates is something people have been trying to forecast since the dawn of mankind, and especially in the last 10 years, and everyone thinks they're going up and they continue to go down. And I will tell you, for the first time in my career, I was worried in the last few weeks how low they were going. It sounds counter-cyclical, but the reality is if they're going too low, that's not a good thing, and it's not even a good thing for real estate. So I think the reality is nobody knows exactly where interest rates going, other than they're going to be generally from somebody who was born in the last 60s, 70s, or older, or even 80s. They're going to be lower than we grew up to believing they were going to be. Other than that, I don't think people know exactly where they're going to be. So how does that work out? Well, spreads are going to be a little more volatile. Mortgage spreads will sometimes bounce in and out depending on corporate bond spreads. So that will be a factor. And then as far as capital, what we noticed in December and November, and what I believe is happening a little bit today, is capital is becoming more selective. It still wants to be in this business, it still wants to be invested in hard assets and real estate, whether it's because as it pertains to Vancouver, there's more Canadian capital going global, yields are getting low, but generally, again, people still believe in this marketplace. So capital's a little more selective, which means that means that there's certain assets will not get the same pricing as it got 2 years ago, a year ago. but the really good assets will still get it. So it's going to see more bifurcation because capital is becoming more selective.
So the cost of capital is really comprised of different elements of risk. I'd say that like interest rates that are sort of, in the first layer, the A piece, if you will, if you look at the Government of Canada bond yields, they're lower now than they were by quite a bit, even in the fourth quarter of 2018. I believe that interest rates are kind of low, and they're going to kind of stay low for a while. There's a lot of people talking about there's going to be upward pressure. They've been low this long, they've got to go up. It's just a matter of time. But every time they start to go up, something happens. Like an economy slows down or there's world crisis somewhere, they seem to moderate somewhat. So I think that interest rates are low-ish, and will stay low-ish through the remainder of 2019. In terms of the B piece, that too I think is going to be somewhat static. And I think that the C piece, the equity, will be static other than where there's a perception of risk in the asset class. So I think that the cost of capital on the C piece will drive the overall cost of capital on possibly some of the residential projects that are out there. In terms of capital chasing yield, capital chasing grade A office buildings, industrial buildings, I don't really see those cap rates or those costs going up that much, if at all. So I think that the cost of capital isn't a big factor on valuations in metropolitan Vancouver in 2019.